Before we begin today's briefing, I want to offer a quick clarification and an apology for the language used in Tuesday's episode. The phrasing around the 2026 presidential election market was unclear and could have been interpreted as suggesting a sitting president was seeking a third term, which is constitutionally impossible. To avoid any confusion going forward, the correct framing is that prediction markets are pricing the probability of the incumbent administration's party retaining the White House, not an individual seeking an additional term. The updated interpretation is as follows: the probability for the incumbent administration's party to retain the presidency has risen due to coordinated endorsements and fundraising momentum, while the leading opposition candidate's probability has dipped only slightly. This reflects a shift in perceived organizational strength, not a change in constitutional reality. Thank you for your patience and for allowing us to correct that language clearly and responsibly. Now let's move into today's Friday briefing. It has been an unusually active week across several prediction markets, and the movements we've seen over the past 48 hours reveal how quickly sentiment can shift when economic uncertainty, regulatory pressure, and geopolitical tension intersect. Today's episode focuses on three markets that have shown meaningful changes: the shifting expectations around interest rate policy, a sudden surge in attention to digital platform oversight, and a quiet but important move in a global supply chain risk market that deserves more attention than it's getting. We begin with the interest rate landscape, where the Federal Reserve holds rates through July. Market has climbed from 59% to 68% since Wednesday afternoon. What's striking is that this movement came despite a series of interviews from regional Federal Reserve officials who emphasized flexibility and data dependence. Traders appear to be interpreting the tone of those remarks differently than the headlines suggest. Instead of reading them as hints toward easing, the market seems to be pricing in caution. Specifically, a belief that the central bank is reluctant to shift policy in the middle of an election year unless economic conditions force its hand. The latest inflation expectations survey, which showed a slight uptick in consumer price concerns, likely contributed to the shift. The market is signaling that stability, not stimulus, is the more probable path through midsummer. At the same time, the rate cut by September market has not collapsed. It has slipped only from 34% to 31%, suggesting that traders still see a plausible scenario where economic data softens enough to justify a late-year adjustment. What's emerging is a split-path expectation, a longer hold in the near term, followed by a potential pivot if growth indicators weaken. This dual-track pricing is typical in periods of mixed economic signals, and it reflects a broader uncertainty about how resilient consumer spending will remain through the spring. Next, we turn to a market that has been unusually volatile this week: major digital platform oversight legislation passed by Q4. This market jumped from 21% to 39% in less than 24 hours after a series of hearings in Washington drew unexpected bipartisan attention. The hearings focused on algorithmic transparency, data broker practices, and the influence of large platforms on public discourse. While none of the hearings produced a concrete legislative proposal, the tone was notably sharper than in previous sessions. Several lawmakers signaled that they were open to a framework that would require platforms to disclose certain types of data to regulators, particularly around content distribution mechanics. What makes this market movement interesting is that traders are reacting not to a bill, but to a shift in posture. Historically, markets tied to digital platform regulation have been slow to move because legislative timelines are unpredictable. But this week's surge suggests that traders believe the political incentives have changed. With public concern about digital manipulation rising and several states pursuing their own regulatory paths, the market appears to be pricing in the possibility that federal lawmakers may prefer a national standard over a fragmented patchwork. Whether that belief is justified remains to be seen, but the shift in sentiment is unmistakable. Finally, we look at a quieter but significant development in the Global Supply Chain Disruption Index exceeds threshold by Q3 market, which has risen from 27% to 35% since Monday. The catalyst is a combination of factors: renewed congestion at several major ports in Asia, a series of labor-related slowdowns in European logistics hubs, and early warnings from semiconductor manufacturers about potential shortages in key components. None of these issues alone would move the market dramatically, but together they form a pattern that traders are beginning to take seriously. The market is signaling that the global supply chain, while more resilient than it was during the early pandemic years, remains vulnerable to simultaneous regional disruptions. This is one of those markets where the movement is subtle but meaningful. A reminder that structural fragility often reveals itself through clusters of small signals rather than a single dramatic event. To summarize today's briefing, the interest rate markets are shifting toward a longer hold as traders interpret central bank messaging through the lens of election year caution. Digital platform oversight has become a live topic again, with markets responding to a noticeable change in tone from lawmakers. And global supply chain risk is quietly rising as multiple regional stress points converge. Across all three markets, the common thread is that traders are responding to patterns rather than isolated headlines, a dynamic that often precedes more pronounced movements in the weeks ahead. Thank you for listening to the Probability Brief. If today's episode helped you make sense of the week's signals, please like, subscribe, follow, and share. You can also listen to the Probability Brief on Spotify and YouTube, alongside Early Indicators Brief, which continues to explore the deeper structural forces shaping global systems. This podcast is for informational purposes only and does not constitute financial, investment, or betting advice. Market probabilities change quickly, and listeners should conduct their own research before making decisions.